Aloha, inspired moneymakers. Welcome to Inspired Money, where we explore stories that redefine wealth. I'm thrilled to bring you today's episode, Money Financial Lessons from History, Insights from Economic Crises. Throughout my career, I've weathered my fair share of financial storms, witnessing how crazy the stock market can be. From the Asian financial crisis to the bursting of the internet bubble, from the great financial crisis to the unprecedented challenges we saw from the COVID-19 pandemic. I've navigated through each crisis, gaining invaluable insights along the way. It's worth mentioning that my father, Samson, boldly raised cash in August of 1987. That was before Black Monday. And his foresight and courage in managing risk left an indelible mark on me and my brother, who we'll be bringing in shortly, shaping our approach to finance and investment. The thing about financial crises is that they're scary. And when you look at your screen of stocks and everything is red, that's even scarier. But it reminds me, or the thing that I think about is a quote from Shelby Davis, the investor, who's known to have once said, "A down market lets you buy more shares in great companies at favorable prices. If you know what you're doing, you'll make most of your money from these periods. You just won't realize it until much later." These words resonate deeply, highlighting the hidden opportunities that crises often conceal. So in today's episode, let's reflect and focus on lessons learned from history's financial crises. And from the pages of economic history to experiences of seasoned experts, we're going to explore how adversity can serve as a catalyst for growth and opportunity. So I hope that you're ready. I'm glad that you're here. Before we bring in the panelists, I just want to steer you to listen to the interview that I did with Robin Sharma a couple of weeks ago. Last week, I bungled the name of the title of the book, but it's The Wealth That Money Can't Buy. I love that he explores 8 different forms of wealth. It does include money, but it is not exclusive to money. And I really enjoyed that conversation. So if you haven't watched or listened, please check it out. Let's bring in our expert panelists. We've got a great group today. I want to welcome back Caleb Silver. He's editor-in-chief of Investopedia, host of the Investopedia Express podcast. He's an Emmy-nominated business journalist who previously worked as senior producer for The Situation Room with Wolf Blitzer, the executive producer of CNN Money, senior producer at Bloomberg Television, and he's frequently a guest on CNBC, MSNBC, CNN, ABC News Radio, and other places. Welcome back, Caleb.
Thanks for having me. Good to be back with you.
Do we have you to the top of the hour, or do you need to pop out early?
No, I'm good.
Okay, cool. So we're gonna have fun today because we have all of our panelists have been here before. I want to welcome back my brother Chris. He's managing partner and director of research at Runnymede Capital Management. Previously held roles as a research analyst and assistant portfolio manager at TIAA-CREF. With over 2 decades of experience, Chris is known for Runnymede's unwavering integrity and distinguished track record in safeguarding clients' assets among turbulent financial times. Chris, welcome back with your red jacket.
Thanks for having me. And I think it's almost 3 decades now, which is kind of scary.
Yeah, and
dating myself.
He still has less white hair than me. He handles the financial crises better, apparently. And then rounding out our panelists today, we have Gary Brode back on the show. He's managing partner at Deep Knowledge Investing, delivering independent stock ideas and market research to sophisticated investors. His career spans mergers and acquisitions and portfolio manager roles at Morgan Stanley, Seneca Capital, Brahmin Capital, John Levin and Company, and founding ventures like Akita Capital Management and Silver Arrow. Gary, welcome back.
Thanks, Andy. Great to be here.
And next time, if you see Gary, he may be donning a top hat and monocle. We were joking before we went live. I was asking, how do you look more sophisticated? And it's always about the monocle.
I'll be ready with that. We're ordering on Amazon as we speak. I'll wait till you do one of your mid segment one of your stock rolls, and I'm going to order a monocle on Amazon right as we're filming this.
They're going to deliver it before the end of the episode. So that's great. With that, welcome everybody, and let's go straight to segment 1. The 1929 stock market crash triggered the Great Depression, leading to widespread economic hardship, unemployment, and deflation, tackled differently worldwide, including the New Deal in the US. The 1970s experienced oil shocks, causing global economic disruptions and leading to stagflation, influencing a shift to neoliberal policies in the subsequent decade. The crisis in 1997 began with the Thai baht collapse, sparking widespread currency devaluations and financial restructuring in East Asia. The 2008 subprime mortgage crisis, caused by the U.S. housing bubble burst, highlighted the interconnectivity of financial systems, with major institutional failures sparking the Great Recession. This overview underscores the importance of understanding economic resilience. Caleb, if you can get us started, as a financial journalist, what narrative similarities and differences have you observed between these historical economic downturns?
Yeah, great question. And it really shows you how the course of history has changed in terms of globalization, the interconnectedness of markets. It used to be when things would blow up, whether they be in Europe or here in the United States or in other countries, those are a lot more isolated incidents. But of course, over the last 3 or 4 decades, as we become more globalized, there's contagion from one market to the other. The great financial crisis is a good example of that. It wasn't just banks here in the US and mortgage companies. It was European banks that were also underwriting some of this debt, that were also selling some of these products to their customers. So the more connected we got, the more contagion you saw spread throughout financial markets. And ultimately, there was no way to isolate these problems. That is kind of breaking back up again. We're in this deglobalization era. So we'll see if we do have that intermarket, intercountry contagion as much as we used to. And the next crisis, we know one's coming. We just don't know when, and we just don't know what it'll be.
The world certainly feeling smaller, but you bring up a good point that maybe isolationism is changing, like the pendulum swings a little bit.
Yeah,
Chris,
I mean, still half of the companies in the S&P 500 make a lot of their revenue outside the US, and that hasn't changed. But just in terms of where countries and sovereign wealth funds are investing their money, that may be changing a little bit, but we're still very tied together.
It was super interesting during the pandemic because it was global, but it was unfolding just slightly different timelines. I just recall talking to people in the Philippines, in Asia, in Hawaii, and it was all just kind of unfolding at a different time, but it affected all of us. Chris, how do the investment challenges faced by individual investors differ from institutional investors?
Yeah, that's a good question. I mean, when I started my career, I was at TIAA, and our bogey was to stay fully invested all the time. I think we could have 5% cash at most. And when I came into the business, it was 1997. So I went through the Asian financial crisis, and then shortly thereafter, the internet bubble bursting. And I remember my secretary coming to my 2 bosses and I, and we're saying, why is my account going down every day? And we're like, I mean, we have to stay fully invested. We really have very little room to move. So I think I was looking for solutions myself. Luckily, we had our dad who had really developed METV, which is his business cycle model, trying to figure out when is a good time to take risk, when you should be taking less risk, and to avoid those big drawdowns, to avoid a 30% drawdown, a 50% drawdown. And we've taken over that legacy. We don't ever want to go to our clients and say we're just staying fully invested and riding the market down 40-50%. We think that you do have to take action, and you can study business cycle and understand when there are times to be more defensive and more aggressive.
Gary, you've seen different market crashes, different crises. I think one of the challenges that each one's a little bit different. Like there are similarities, but the catalyst is often different. Curious, can you talk a little bit about, like, I guess historically, like looking back at some of these crises and things that we can learn, the different lessons?
Sure. And let's take a really long view, because all empires rise and fall, everything fails, but the way they fail is always the same. All empires end with overexpansion, war, and debt. Yeah, it happened with the Roman Empire, it happened with the Spanish, it happened with Great Britain, and we're starting to see examples of extreme stress here in the United States for similar reasons. Worth pointing out that everything the government is doing right now is designed, whether intentionally or not, to make things worse. Currently, massive amounts of government spending is destroying value. We were just talking about this before. The increase in GDP is less than the increase in government debt. And because government spending is additive to GDP, what that means is that government spending actually has negative value and is pushing out private investment. We also see them lying openly about infrastructure investments. We've been talking in this country for decades about a need to renew infrastructure and invest in infrastructure, but the truth is, things don't get built. You could be in environmental review for 10 years. And so what we're doing right now, what our government is doing right now, is they're spending money on consumption and pulling demand forward, and telling us that it's infrastructure investment. It is not. Infrastructure investment are things that we'll all benefit from for decades and will produce basically positive returns. Pulling consumption forward is a completely different story. It's about as advisable as all of us maxing out our credit cards to buy new TVs and buy first class air travel.
The difference is I don't have a printing press in my basement.
Well, so you don't have a printing press in your basement, but let's talk about what this means for a second, because historically the government has financed itself through taxation, and that forced people who had to write their checks, on April 15th or throughout the year to pay their taxes, to really ask hard questions about what's the proper size of government and are these programs worthwhile? And if they didn't like it, they would vote people out and, maybe want bigger or smaller government, but they were part of the decision. Our current government has decided they want to finance themselves through inflation. And that's what they're doing. They're printing money, they're adding to the debt. And the reason they like that is because it's very easy to blame inflation on everybody else. If it's taxes, everyone knows to blame Congress. But if it's not taxes, if it's inflation, they can blame Putin, they can blame supply chain, they can blame COVID, greedy corporations, which of course are only greedy when your party is in the White House and then, the other party complains. But this is what we're seeing. And the reason they like funding it with inflation is because they don't have to make hard choices, right? We can spend on guns, butter, everything. We're well into the bread and circuses part of the show at the moment. And they don't have to make choices. So everything their constituents want, they say, hey, we're getting you more spending. And people think that's terrific and it's free, but it's not. We're all paying for our stimmies through greater inflation.
Caleb, anything to add?
He's not wrong. And I've heard people ask Warren Buffett this question too over the years, and I'm going to be heading out to Omaha next week, and I'm sure he'll come up again. And he would say, well, the follow-on question for investors is, well, what does that mean? For my portfolio, I've been worried about this for a long time. And he would say, you could have been worried about it for the last 50 years, but you would have missed one of the greatest bull markets or several of the greatest bull markets in history if you are not invested. So this is all true. This is the economic paradigm we are in, and it's hard to think about ever getting out of it. There is a moral hazard there. There is the fact that, spending is the only thing sometimes to keep the economy juiced right now. Certainly we needed it in the depth of the pandemic, but arguably we spent way too much money, or the government handed out way too much money after the fact, that it put us in the situation we're in right now. But if you weren't invested during that whole time because you were worried about that, well, you've missed out on incredible returns. And I don't know if you'll see these ever again.
Great point. You can't let your worry keep you out of the market because there's an opportunity cost. But as we talk about the government spending, that's a good segue. We'll go to segment 2. Historically, governments counter economic crises with a mix of monetary easing, fiscal stimulus, and regulatory reforms. Examples include lowering interest rates and buying securities to add liquidity, alongside tax cuts and increased public spending to bolster demand. For instance, during the COVID-19 pandemic, the U.S. enacted the CARES Act, providing direct financial relief and expanded unemployment benefits, while the Federal Reserve took aggressive steps to stabilize the market. Such actions aim to stabilize the economy and stimulate spending, though they may lead to higher national debt and inflation risks. Regulatory reforms typically follow significant downturns, influencing both policy direction and public sentiment. So in the last segment, Caleb brought up the great point that there are many things to worry about. There's always a wall of worry, but there's an opportunity cost if you're not invested and a bear market, in fact, doesn't come. And right now, we've been waiting for this economy for even a recession to come. It's been very elusive. Chris, how should individual investors respond to government interventions like monetary easing or fiscal stimulus during an economic crisis?
Yeah, I mean, for the individual investor, I mean, I feel like investors in general, a lot of them were counting on the Fed in recent years to bail them out in terms of whenever there is a crisis or there's a recession. So is a question long term of, can the Fed keep on doing this time and again? And I think after the great financial crisis, they had driven their balance sheet up to unprecedented levels, providing quantitative easing. It's just how much ammunition do they have each time around? This time they have raised interest rates, so they could cut the next recession. We'll see what they have left in their arsenal when a recession comes over and over. But I think that investors in general just are counting on the Fed put in bailing them out, and eventually that would run out.
Caleb?
Yeah, I don't see how they don't but bail out whatever happens next time. This is a moral hazard that they've now decided that this is the way that they are going to act. And you can think about, Ben Bernanke, who did this, who was a student of the Depression. He knew that if they had just thrown that helicopter money down onto the economy, it wouldn't have lasted as long, and it wouldn't have been as severe. So he brought that to bear during the great financial crisis. And that was the solution in terms of getting the economy out of the rut. It worked. It did blow open some parts of the economy and created some broader income separation between people, right? More income inequality. The shareholder class got richer. The asset owners got richer. And we saw it again during this COVID crisis too, right? Helicopter money. Shareholders got a lot wealthier. Homeowners got a lot wealthier. That class of people did well, but the split between the haves and the have-nots just gets more and more divided. But there is no other solution from a monetary policy point of view other than to pour money on it, because nothing else actually works without doing greater damage, especially to lower income people.
Caleb, are there any critical lessons that the financial media have learned from covering government responses to economic crises?
Yeah, I mean, and that took me a lot of lessons. I cut my teeth during the internet bubble, lost a lot of money, but also learned a lot as a journalist. And then during the great financial crisis, you have to assume that anything can happen, right? The thing that you don't think can happen can easily happen. Who would have thought a pandemic would have shut down the global economy basically overnight, right? Who would have thought that Lehman Brothers, a 108-year-old financial institution, would go under, and that the Fed would allow that to happen? So anything is possible. And I think as business journalists, we get used to the things just working out the way they used to work out in the past. Anything can happen, and we should just expect the unexpected and be prepared to ask tough questions when things are happening.
Yeah, no kidding. I mean, it was incredible watching the news coverage of Lehman employees carrying out their desk belongings in boxes. Unbelievable. Yeah. Gary, how have past government interventions affected the investment landscape for individual investors? And how do you incorporate these interventions in your research?
That's a great question, and I think the topic that keeps coming up is moral hazard, and that's what we keep seeing, right? The government, by bailing people out again and again, creates an incentive to take inappropriate risk, and we're seeing that constantly. And so, one of the things that we've been talking about a lot in our weekly piece, the 5 things to know in investing, this week, is we've been talking a lot about commercial real estate, and people are telling me, well, we don't think it'll be as bad as 2008. And I actually agree with that. There's less leverage in the system right now. And that part makes sense. But I'm already hearing credible rumors that Washington is preparing another bailout. And, capitalism without failure is not capitalism. We are basic. And it's not, by the way, it's not just corporations. It's not just the stock market. We're seeing it on an individual basis as well, right? We're going to have debt forgiveness for this and debt forgiveness for that and student loan bailouts. And by the way, I would love for people to stop using the term debt forgiveness. The debt is not being forgiven. It's being transferred. It's being transferred from people who took that debt on to people who didn't. And whether it's student loans or corporations or another bank bailout or a commercial real estate bailout, those are the kinds of things that we see again and again. And when that happens, there's an expectation. So one of the reasons why people are comfortable owning huge positions in banks right now is because they feel like if the banks have great returns, they take risk and it works out well, terrific, they'll get paid. If they don't, the government will backstop them because it would be terrible to have banks fail. And what the government is great at doing is blowing up ever larger asset bubbles. And that's what we keep seeing. And that's why the amplitude of these crises keeps getting worse and worse, because we just print more money, we bail out people more. It blows up another giant asset bubble. The Fed did it by keeping interest rates at zero for more than a decade and having a $9 trillion balance sheet. So that's their answer to all of this. And, we talked about Bernanke, we talked about the Fed put. That's what people are expecting. There is this incorrect assumption that everything will always be okay because Big Daddy government will make it so.
Let's go to segment 3. This topic examines cognitive biases and the effects of social media on investor actions during financial crises. Panic selling and herd behavior are prevalent biases where investors driven by fear or peer actions make suboptimal decisions that can exacerbate downturns. The advent of social media has intensified these behaviors by accelerating information spread and amplifying emotional responses, thereby increasing market volatility. Observations during events like the Silicon Valley Bank collapse and the COVID-19 pandemic underscore the impact of these psychological dynamics. Understanding these biases is crucial for better financial decision-making and achieving market stability. Caleb, what can we learn from Investopedia.com's analytics? Does that teach us anything about investor sentiment during financial crises?
Yeah, we have lots of ways of tracking this, and the main way is just to see what people are looking for. We've got about 15 million people a month coming to Investopedia, unique visitors, asking a very specific and personal question about money. Now, it could just be somebody looking for the definition of EBITDA, but more often than not, it's somebody who has to make a decision, right? 401k, Roth IRA. How do I invest $10,000? Should I invest or pay down my student loans, right? This ETF or that ETF. So people are here with an intention. So when we look at that on a daily or even an hourly basis, we know what people are feeling. We created an anxiety index right after the financial crisis to track traffic to fear-based terms around the economy, personal finance, and the macro economy, right? So when we see spikes in the anxiety index, that shows that people are afraid of something and are looking that up, and then they take action. This anxiety index precedes the VIX because that's the way we operate as human beings. Wait, what does this mean? Bank failure? Banks being taken over by the FDIC? What does that mean? Oh, I want to make sure I'm not in those stocks. So people come to us first. Anxiety right now is pretty low, even though we've had some volatility in the stock market over the past couple of weeks. Generally, individual investors feel pretty confident as they've been in a long time, but they're not confident by and large about their personal finances. So we see spiking searches for personal loans, for bankruptcy protection, for should I tap my 401k. It's not off the charts. It's just bubbling right now. And that's the type of thing we pay attention to. If people don't feel secure in their personal finances, the thing that usually ends up suffering beyond the household expenses and the budget and the cuts they have to make is further additions to their portfolio. Right now, we're not at that point yet, but we're starting to hear a louder and louder drumbeat. So how can you have a stock market at or near record highs, an economy on a headline level that looks pretty strong, but people across the country feeling like it's not strong at all and are worried about their home?
Yep, that makes sense. I mean, since the market averages are not that far off from the record highs, but costs are still relatively high. So I think looking at personal finances, you feel like you're spending quite a bit on groceries still. But the good news is that people tend to feel better right now because their 401k balances are healthier than they were.
The wealth effect is real. And when people feel wealthy, whether it's because of the 401k balance or their neighbor sold the home down the street for a much higher price than expected, that's real. And we love spending anyway. So it just gives us more reason, those that can, to keep spending, and those that can't keep spending anyway. And that's why we have record credit card debt as well.
Yes. Chris, can you cover some common financial missteps that individual investors make during market panics, and how can they avoid them?
Well, I mean, simply, most people buy high and sell low. But I mean, I think it all comes down to like the Warren Buffett famous quote, be fearful when others are greedy and be greedy when others are fearful. I think it sounds very simple, but it's difficult to execute. I think we do have to have a disciplined investment philosophy, and we're all emotional beings. So if you can control your emotions on the ups and the downs, I think you're going to come out better. But that it's definitely a challenge for sure. I think even on the greedy side, when you're making a lot of money, it's hard to take profits. And there are times where you definitely want to be booking gains. I think on the other side, you do want to be buying when people are panicking, but you also have to have the funds. So unless you are taking maybe a defensive position at the tops of the markets, or sometime you are booking gains, you don't have the cash on the sideline to implement when people are panicking. So you do have to make sure you have an investment process that you're following, and you don't panic when the markets are selling off and in the red. And when there's a big bear market, you should probably turn off your Quotron or not read the newspaper headlines, because that's just going to trigger you. Avoid social media, that's for sure.
That's a sign of our age. Is there a Quotron anymore? I don't think so.
Probably not.
Gary, when it comes to market crashes, how do the responses of seasoned hedge fund managers differ from the average consumer, since that's a world that you've been in?
I think there are two things that are really different. One is, let's go to what Chris was talking about before. When he was managing money in a particular place, they said, look, you got to be 100% long all the time, or very, very close to it. I think one of the great things about the hedge fund side of the business is we're willing to change exposure, and very quickly, depending on the environment. Amateur investors tend to not change their strategy for the environment. They don't make different decisions. Whereas I can look at something and say, yeah, this is a disaster. I'm going to reduce exposure. I don't need to be 100% long. Or there are times, I can just short things. I can short the market. I can short individual stocks. I can take bets that will benefit from higher inflation or higher interest rates or a market downturn. There are all kinds of things you can do to protect your portfolio if you're willing to not be 100% long all the time. And I think that's something that's really important, being willing to change your strategy a little bit. The second area where we might be a little bit different is decades of being in this business. It doesn't teach you, nothing teaches you to emotional control. You can't control the fact that you might feel anxiety or worry, or, that horrible feeling where your stomach feels like it's coming up through your throat. Losing money is horrible. But as a professional investor, you learn to quiet that voice and focus on valuation, on market conditions, on what do we do next? Do we realize this loss? Do we add to this position? And it's okay to have those feelings. When people say, what keeps you from sleeping at night, or how do you sleep all night? Like, It's not my job to avoid being worried. Part of my job is to accept the fact that running money, managing money, being responsible for other people's financial well-being, you should have worry at times. But the real professionals can put aside those feelings and say, okay, leaving aside the fact that I feel anxiety right now, what should I be doing? And that takes decades of practice and control to be able to do that.
Yeah. Gary has to do something. Andy, you guys have to do something. You're professional investors or you're running money for other people. Most people, most 401k customers or IRA and people that are just contributing passively to their retirement accounts and their investing accounts, they don't have to do anything, right? We can just stand there, as John Bogle says, and just let it happen. Or we could buy when we feel like the market's sold off enough. But people feel compelled to do something, and I think financial media has a lot to do with that. And I'm guilty as charged. I work in this business for a very long time. But we treat the stock market, especially on TV, like it's a football game, right? Like it's the Super Bowl, the pregame, the kickoff, the first quarter checkup, the market check, the halftime show, 1 minute hour till closing bell, last minutes of the closing bell, the post game. Like you have to do something. No, that's entertainment. But for most passive investors, most individual investors, either work with a financial advisor you trust who's going to make the right moves that according to your plan, or stand there and do nothing and just keep buying.
So, Caleb, I think that's a great point. I would just relay a story that I heard over and over again in 2022. Some of the people that I talk to and work with are registered investment advisors. And I would talk to them in 22 when the stock market was down 30%, the bond market was down 30%, their 60-40 allocation wasn't working. And they told me they were spending all of their time on the phone, basically playing psychologists, dealing with their clients' anxieties. And I said to them, well, what are you doing with their portfolio? And their answer was nothing. I said, let me get this straight. Your stock, your 60-40 split that was supposed to save people, you're down 30% on one part of it. You're down 30% in the other part of it. And you think the problem is your clients have anxiety? You've just crushed their net worth by 30%. You didn't do anything. The job here isn't to make them feel better. The job here is to help them have better finances. And how did you not see this coming, at least enough to reduce exposure? And I understand if you're an RIA, you can't just go to cash, or you can't tell everyone we're just buying gold and Bitcoin or oil. I get that they have risk controls that they have to live within, but they just rode this all the way down and somehow thought the problem was that their clients were upset. No, the clients were upset because these people, these professionals weren't doing their jobs. So I agree with you, but I do think, and you're right, the stock market should not be treated like a football game. It should be treated as something serious. And the answer to everything isn't do something. But, the other side of that is I've seen people who should have done something and they just sat.
Yeah, no, you make a great point. And that's why you have to have a rules-based approach. I have it with my financial advisor. We have a plan. We have a rules-based approach. And we also have what Burton Malkiel calls in the great book, A Random Walk Down Wall Street. This actually came from the CEO of Bear Stearns back in the day, the sleepless number. What's your tap out number? You can have that set. I can't take losses beyond 25%. I can't take losses beyond 50%, or I can't take a loss beyond 10%. People need to set that threshold, the tap out number. And to Chris's point, what's your cash in number, right? When is enough in terms of how you've been able to make some profits that you feel good about now moving that to something else? That's strategic investing. That's rules-based. That's evidence-based. Most people don't do that. Professionals like you do it. But you have to establish that if you want to be a market participant.
Caleb, that's a phenomenal answer. And one of the things that I talk to my subscribers about a lot is risk control. And what I try to do in any position that we're putting on, anything that we recommend, is give them a sense of the reason I own it is because I think the upside is this. But here's what the downside is. Here's what that looks like. And as a result, this is something we should be huge in. Or the next thing we're coming out with is one where the upside is enormous, but the downside is huge as well. And I'm telling people, you need to do this small, right? You should have a position in this because the risk reward is good, but the risk is really high. And so you don't bet your net worth on something like this. And I spend a lot of time coaching my people on exactly what you're talking about, which is risk control. And the way we express that is position sizing. And so I love your approach. I love the way you're thinking about it. What we're doing at Deep Knowledge Investing is very similar. It's a similar analog to your approach. So I really respect the way you think about it.
One thing that I want to share is the emotional aspect. And as Caleb talked about, financial news on TV tends to stoke your emotions, which is why so many financial advisors and professionals that I know, they have the financial network on, but they have the volume off, because they're like, if I listen to the sound, it just gets me tense and excited. And similarly, like I remember when we had a Bloomberg in the office and you have real-time price quotes, you end up staring at that during the day. And it just potentially causes you anxiety, sometimes even makes you, can be a catalyst for making a decision that could be regrettable. And back in the day, we used to also have a service called Baseline, which is no longer around. Baseline used to update once, like overnight. So it was daily pricing. And we found that we did our best research, our best work in clear thinking, looking at Baseline, because the prices weren't flickering green and red. Like, it wasn't distracting. You're just looking at it. We're looking at earnings. We're looking at the balance sheet. And we felt like we could make better decisions when things were quiet versus having a lot of noise and distraction. Let's move to segment 4.
When economic storms hit, you may face uncertainties like sudden job loss or unexpected expenses. Building an emergency fund is important for weathering such challenges without making hasty decisions driven by fear. It can be difficult to stick to your financial plan and maintain a long-term perspective as an investor, but your resolve during market downturns can transform short-term losses into long-term investment opportunities. Keep calm and carry on. In times of market downturns, consider leveraging your cash reserves by investing more when stocks are selling at bargain prices. Dollar cost averaging is the practice of periodically buying more shares as share prices drop. It's a good way to develop a disciplined investing habit, be more efficient in how you invest, and potentially lower your stress level as well as your costs. By staying disciplined and avoiding emotional reactions, you can navigate through rough patches while safeguarding your financial future.
I like that Caleb mentioned the Investopedia Anxiety Index. Gary, I'm curious, are there other market sentiment indicators that investors can follow to help make more, I guess, disciplined decisions?
You know, I don't know that there's a thing that people can track and say, okay, well, I've got this one number. If you're talking about tracking something like an anxiety index, the thing that everybody looks at in my world is the VIX, which is a measure of volatility. And it basically becomes the insurance premium for options. And I think that's the thing that we look at as kind of the anxiety indicator. You know, I'd relay kind of a funny story about this, because you're talking about the errors that investors make when they don't follow a plan. And a friend of mine was once advising a group of family offices, and he presented a few ideas, a few stock picks, and he's a phenomenal stock picker. And, everybody in the room, they thought they were very sophisticated. And they said, well, we don't really want to pay up. We don't want to pay current prices. We'd buy these stocks if they were down 40%. It was a really easy thing to say because they didn't think the stocks would be down 40%. So they felt like they were making a decision, but, they're making a decision for circumstances that were unlikely to come. But the thing that my friend and I were laughing about is when the conditions occur that cause those stocks to be down 40%, trust me, these people aren't in there buying, right? They want to buy down at a price that's 40% cheaper, but not in the conditions that would cause the stock to be 40% cheaper. That's the moment when all of these people panic and blow out of their positions and, go to cash when, as multiple people in the show have pointed out, they should be committing capital.
Caleb, during a financial crisis, is there financial management advice that's often overlooked by the general public? Or during a crisis, you just have to go back to basics?
Yeah, you have to do a little bit of both. But the thing that you learn as you become a more seasoned investor is this may not have happened this way before, but I remember certain things like this happening, and I remember what happened after it. So I was just doing a quick search of global economic crises over the last century and how the stock market reacted to them. And we've had some big ones where the stock market, obviously on a 9/11 type situation, or even on the COVID, March 13th, 12th or 13th of 2020, where the market will fall 12, 13, 17%, or it might fall 35 or 40% over a period of time. Then you have to look at it a year later and say, how long was it in this period of decline? How long did the decline last? And if you look at the last 20 or 30 years, the period of recovery is a lot quicker than it used to be, right? The Great Depression took years to get out of, right? The area of inflation and the recession in the 1970s took years and huge interest rate hikes to get us out of. But now these things come and go a lot quicker, and the recovery is a lot quicker. So while the media, and especially financial media, is trying to get you to react, because I'll give you the dirty little secrets from a TV producer in financial media, we just want you to react. We want you to turn up the volume. We want a reason to put that breaking news scroll across the bottom of the screen. We want a reason to do market and turmoil crisis tonight special at 8 p.m. We're looking for a reason to get you to tune in. But most of the time, and the more you experience this, the more you realize, I've seen how these play out before. It gets bad, and then it gets better. And if I'm not in it when it starts to get better, I'm going to miss out on some of the best returns in the history of the stock market, because you guys know this. The best days in the stock market, or half of them, occurred during some of the worst bear markets. Those big 5, 7, 8% jumps in a week, or even over the course of a couple of days. That doesn't happen in the normal cycle of a regular secular bull market. It happens when the market is bottoming out.
I appreciate Caleb's real talk about financial media, and a great point that, it was back in 2000, internet bubble bursting, where we had a bear market, 2000, 2001, 2002. That was a long one. But most recently, it seems like the cycles have really tightened and shortened. Like we have a bear market for a few weeks, and then we have a bull market. So we have like every other month is a bull market, bear market. Chris, maybe you can talk a little bit about like having a disciplined approach. How do you remove emotion from the process?
Good question. I think it's tough a lot of the time like I said before, I mean, we're emotional beings, so you can't totally remove emotion. It's just, I think you can change your reaction to the emotion and not respond if the market's down and you are triggered, because I don't want to lose money, but you have to change your response into, hey, maybe I should be buying and I should be looking for things. And I think it is a funny industry where people don't, it's kind of like what Gary was saying. People don't want to be buying stocks on sale. Even when stocks are down 40%, that's not when they're usually committing their capital. They're usually buying when things look clear and easy and the sun is shining. So it's just, I think it takes experience. And the interesting thing is, I feel like after the Great Recession, I mean, since 2009 up until COVID, you really didn't have a bear market. In the COVID panic, it was so short that, I mean, a lot of people, I don't even think they felt it, because everything just bounced back so quickly. I mean, we did have a rolling bear market in 2022, but I don't know. Like Caleb said, I mean, now things just happen so fast. I mean, it's every other year's bull market, bear market. Things are moving in hyper speed, I feel like, nowadays.
I know that when we have investment meetings, you're almost talking out loud sometimes, because in normal times, you're talking about, if there is a crisis, it's like you're making notes. You're like, I have to not be emotional, and these are stocks or ETFs that I want to buy. I want to commit to buying to. Is it important to kind of set those goals during times of like normalcy?
Yeah, for sure. And that's when you're kind of laying out your discipline process. And what I have found is that coming out of a bear market, it is the technicals that turn first. I mean, the market does seem to start pricing in that things are turning before it feels good, before the economy turns, those technicals turn. So you do have to look at the stock market for some indication that things are going to rebound.
Let's bring it home and go to segment 5 and talk about preparation.
In readiness for economic downturns, investors should prioritize several key strategies. Diversify your investment portfolio to mitigate risks, considering alternative asset classes that do not move in sync with traditional markets. Next, establish a financial safety net by setting up an emergency fund to cover unexpected expenses or temporary job loss. Having this buffer ensures you can navigate through tough times without dipping into long-term investments or going into debt. Additionally, consider securing a line of credit during stable periods. This provides access to borrowing options if needed during challenging circumstances, offering additional financial flexibility. Finally, remain agile by adapting your financial strategies to changing market conditions, ensuring resilience and prosperity in the face of future economic challenges. Proper preparedness through these strategies can help safeguard your financial well-being and pave the way for long-term success.
Gary, I have a question about strategy and implementation. How should individuals tailor their investment strategies to better withstand future economic shocks?
Okay, so let's talk about their portfolio and non-portfolio needs on that. One of the things that you need to do in bad circumstances is make changes to your investment plan, right? I mean, it's great to have a plan, but I'd spent my whole career focused on a variety of companies, but never dealt with metals, commodities, things like that. We hit 2020, and all of a sudden I'm realizing that inflation is going to be a giant problem, and started to look into things like gold, Bitcoin, energy, oil, uranium. I'd also remind people that you do have the option to short things. And I know people say, oh my God, we can't have individuals shorting stocks. That's too dangerous. And okay, shorting can be dangerous, but it's worth it to point out that being 100% long all the time in some of these environments can be shorting stocks can be a way to reduce exposure. So there are all kinds of non-correlated things that you can do to separate your performance from market performance, or do things that would act, at least on a temporary basis, as a store of value. The second thing I'd point out is, if you really want to be calm, take care of some of the non-financial aspects of your security. And so, we love to focus on finance, but take care of the basics first. And if we're going into what you think is an uncertain or dangerous economic time, make sure you have a supply of food, water filtration equipment, PPE, cleaning supplies, important pharmaceuticals, whatever level of personal protection you're comfortable using or having in the house. Once you have those things, those are the things that will keep you alive and will keep you safe. And then you start to view the financial end of it a little differently. And it takes some of the emotion out of it. Take care of your basic needs first, and then go to the portfolio. The final thing that I would remind people of is your emotional approach to these things is really important. I used to be a competitive marathoner many years ago, and it's very painful, right? To run as fast as you can for hours, to keep your heart rate right around your maximum for hours. It's horrible. It's an incredibly painful thing to do. But what you do is you remind yourself that the feeling that you're experiencing isn't you. It's merely something you're experiencing right now. There are a lot of things that will happen in the coming years that will make people upset and worried and anxious. And those feelings, those stressful feelings, are completely normal and expected, and you're going to experience it. But remember, that's not you. It's just something you're experiencing at a particular time. And you can still calmly make the decision to do what is going to be the safest, best thing to do under those circumstances.
Thank you for making me feel better about the cans of Spam in my basement.
Right. Toilet paper doesn't expire. It won't go bad.
Caleb, are there any underappreciated financial signs that a journalist can pinpoint as early warning signs for the next economic downturn?
Yeah, I would love to say when there's smoke, there's fire, but that's not always the case. And sometimes there's no smoke, and all of a sudden you have a blazing forest fire that can really engulf things. But let's just think about the banking crisis, which is basically a year ago plus, right? Silicon Valley Bank went under. We had First Signature Bank and a couple other banks teetering. Some of them were taken under by the FDIC and sold to other banks. That looked like it could be a complete unraveling, right, of the entire market, contagion spreading from regional banks, to the bigger banks over to Europe. That looked like it had the makings of something terrible, even though the FDIC and the Treasury stepped in. What did? they poured money on the thing, right? And then they arranged a sale, and it was over before it even started. So sometimes the things that think that you're going to turn into, bonfires just peter out, and sometimes the things you think are nothing turn into very big deals. Like, let's talk about Enron for a quick second. I was just interviewing Bethany McLean, who wrote The Smartest Guys in the Room. Enron had magical numbers. They were creating money out of thin air. The market cap was growing. This is way back in, pre-financial crisis, but it was manufacturing things. When things are too good to be true, or they sound like they're too good to be true, think, about Sam Bankman-Fried, then they usually are, right? So don't get too high, don't get too low. And the thing that you can do, the one thing that I remember, not just as a journalist, but as an investor, signs that it's time to do something. When the Fed floors interest rates to zero, it's time to go. And I learned that in the financial crisis. And I was around experienced people that said, this doesn't happen. The interest rates are zero, push your chips in. Is that going to work the next time? It certainly worked in 2020. In 2021, is it going to work the next time? Just because it worked last time doesn't mean it's going to work this time. But there are patterns you can see over time. They're like, there's a time to go, and there's a time to not do anything, and there's a time to get out. So as Kenny Rogers in The Gambler says, no one to hold them, no one to fold them, no one to walk away, and no one to run.
Great quote. Chris, what products and strategies can help people to prepare for financial crises and bear markets?
Yeah, I mean, we're always looking at different products to help protect clients. One of the ones that we use is the Pacer Trend Pilot series, which basically is a very technical, rules-based approach. If the S&P 500 crosses below the 200-day moving average, it moves to 50% cash. And then if that 200-day moving average, its slope turns down, it would go to 100% into T-bills. And what we have found is that in, I would say, cyclical bear markets, the product works very well. That would be a 2000, a 2008, even 2022, when you had a slow-moving bear market. It did its job. It protected assets, and then it got back in when the market turned. The product, its shortcoming is like a 2020, where you just have a sharp move down and it just cuts straight through the moving averages, and then the market snaps back. So it can get whipsawed. I would say that would be the negative. One new product that I saw just come across my desk is Calamos is launching an ETF that provides 100% downside protection. This is a buffered ETF. There's been series of these giving you 10%, 20%, 30% downside protection. This is the first giving you full protection. It's an option-based strategy. It does give a 9% cap right now, which I feel like that's actually a pretty attractive product, but it's a question of, will the product work, and will it produce the way it's intended to if something did go haywire in the financial system. But those are two products I think are interesting. I would just say also, just when you think about market returns, it's a lot of the time it's not like maybe the trend is up and the average gain in the market is around 10% yearly since 1980, but there are very many extremes. Like I think it's 30% of the time the market's up 20% or more, and 10% of the time the market declined 30% or more. So you overshoot in both directions. You just have this positive and negative push and pull. It's not just the steady 10% return every year. It's rare, actually, that you kind of hit that exact 10% mark.
Right. And that you have pullbacks even in a bull market when the market finishes up double digits for the year. So one thing that I wanted to mention is that the products mentioned by Chris are just things that we either use for clients or we're monitoring. We're always trying to learn. I think that the good news for everybody is that there are a lot of choices out there. There are a lot of new strategies and products that come in different forms, whether it's an exchange traded fund, a mutual fund, and they are not sponsors of the podcast. So we are just mentioning them with unbiased. I want to thank our panelists for joining today. Everybody really shared fantastic insights and gave us context into what has caused different financial crises, how we can manage our emotions through different financial crises so that we can see them as opportunities, even though they are very scary. But it's really about having a plan in place and having a discipline in place so that you can make good choices when things are on sale. Thank you to the Inspired Moneymakers for joining us, for watching, for listening. I encourage everybody to follow our panelists. For more information, Caleb Silver, check out his podcast, Investopedia Express. You can find him and so many great articles at investopedia.com. Chris Wang, who is my brother and colleague, you can find both of us at Runnymede.com. And Gary Brode, thanks for coming back. He's managing partner at Deep Knowledge Investing. So you can find him at deepknowledgeinvesting.com. Thanks to the panelists. We'll be back next week on Wednesday, May 1st. Our topic, a little bit different from financial crises. We're going to be talking about advanced watch collecting techniques. So I think we're going to be having some fun with that. Until next time, do something that scares you, because that's where the magic happens. Thanks, everyone.